You have a solid strategy, you hit winning trades, but at the end of the month, your profits are slipping away, and you can't figure out why. Capital evaporates when traders repeat the same behavioral errors without ever identifying them. There is a distinct line between a gambler and a professional. A gambler relies on instinct. A professional measures every single variable to see exactly where the leaks are. Today, we are going to build a complete 10-column tracking framework from scratch. You don't need expensive software. Any basic spreadsheet will work. By shifting away from guesswork and forcing yourself to track the hard data, you stop treating the market like a casino and start managing your trades as a measurable, scalable business. Step 1 is building the skeleton of our journal to record exactly what happened. We start with the basic inputs: date, stock name, entry price, exit price, and quantity. Logging these numbers is necessary clerical work, but on its own, it won't fix your performance. Next, we build the risk management engine, dictating actual profitability. We expand our grid to include stop loss, risk per trade, and risk to reward. Let's log a mock trade. Enter at 1500, stop 1490, target 1530. Your system instantly calculates a 1-to-3 risk to reward ratio. Tracking this exact metric across hundreds of rows proves a mathematical reality. Long-term capital growth is the result of disciplined risk management, not a flawless entry record. Step 3 moves us into execution. You need to log the specific setup type, like a breakout or a pullback. Over time, your memory of why you took a trade will warp. You must save entry and exit screenshots. Linking that visual evidence directly in your spreadsheet guarantees an honest review later. Step 4 introduces the psychology tracker, focusing on the mental state behind the execution. Log the core reason for the position, your emotional state before, during, and after, and any mistakes made. By color-coding these entries, a behavioral map emerges. You'll instantly see how the emotion of fear maps directly to an early exit across dozens of sessions. Isolating these patterns is the only way to surgically remove destructive habits. You can't fix a flaw until you can see it clearly on paper. The final step is establishing a review routine. Gathering all this data is entirely useless if you never read it. At the end of every month, you need to calculate 4 key performance indicators: your total trades, your overall win rate, your average winning amount, and your average losing amount. Consider 100 trades with a 50% win rate. 50 wins, 50 losses. If your average winner yields 3,000 rupees and your loser costs 1,000, those wins generate 1,50,000 rupees against 50,000 in losses. The result is a net profit of 1,00,000 rupees. Seeing this math during your monthly review relieves the pressure to be perfect. It proves that aggressively cutting losses is far more powerful than trying to win every single time. This complete 10-column framework is now your operational command center. It holds your entry data, your risk metrics, your psychological patterns, and your visual proof. Your challenge is to log every single trade into the system for the next 30 days, without a single exception. Avoid the temptation to only record your winning setups to protect your ego. Hiding your losses destroys the integrity of the data. Let us know in the comments below which platform you plan to use to build your journal: Excel, Google Sheets, or Notion. Market longevity requires a ruthless willingness to confront your own errors. By maintaining this journal, you force yourself to adapt, improve, and execute like a professional.